So with that, we're just delighted to have with us visiting in New York, our partners from London, Peter Pierce and James Taylor. Peter and James work very closely with us on a very broad array of debt capital markets transactions. And more debt capital markets transactions have been involving an ESG flavor to them. So green bonds, sustainable bonds, sustainability linked bonds. With that great interest in all things ESG comes some additional risk. And during today's presentation, in addition to making us acutely more aware of the legal framework in the EU and in the UK, Peter and James will sort of sensitize us to some of the risks for financial intermediaries in these transactions. So thank you both.
Thank you. Hopefully you can hear me now. Yep. So that we started giving this presentation about a year ago, and that was really born out of questions that we got from a number of clients in Europe about exactly the things that Anna just mentioned. So ESG regulation, but also this growing idea that since we've had green, social, sustainable and sustainability-linked bonds in Europe since about 2008, an increasing recognition that actually they're a great thing, but they might bring with them some additional risks, both from a litigation perspective, a reputational perspective, a regulatory perspective. So the points we're going to go through are there. We'll also talk a bit about this slightly nebulous concept of greenwashing, of which there's a lot of work being done in the UK and Europe and also in the US in terms of trying to conceptualize the idea. A bit about sustainability-linked bonds, so some of the product-specific risks in relation to sustainability-linked bonds, which are becoming increasingly popular, but themselves also increasingly subject to accusations themselves of greenwashing. And then the idea is not that we just sort of sit here, tell you all the risks, and then leave you with it. We're going to try and give some sort of practical recommendations through checklists about things that you can think about on day-to-day transactions to help you mitigate those concepts. So on the regulatory point, I'll hand over to James to tell us a bit more about what's going on in the EU and the UK.
So, I mean, I think that we thought about how we would structure this presentation, and actually it came to the conclusion probably everything does start with the regulation, because it's the regulatory activity in the EU and the UK and often further afield for us. And the tighter regulatory regime that is leading to potential risks, both regulatory risks, obviously more an additional scrutiny from the regulators, but also reputational risks and potential litigation exposures for clients. So it's really important we start with at least a basic understanding of what the regulatory regimes are in the UK and in the EU. And we'll start in March 2018. We could have gone back further, but we could spend, a whole hour just discussing nothing other than the regulations. But so we start in March 2018 when the EU published its action plan on financing of sustainable growth. And the key here is the word sustainable. We're not just talking about the E in ESG, we're talking about the E, S, and G in ESG. And it wasn't just a set of kind of lofty ambitions, it was a full work plan for the EU in terms of developing a sustainable plan. So it included the establishment of a classification system for sustainable activities, developing kind of robust science-based green and social labeling, incorporating sustainability into investment decisions by financial market participants and financial advisors, asset managers, pension funds and the like, and ensuring that those intermediaries that sit just before the end investor had all of the data. So ensuring that from a corporate perspective, there was a corporate sustainability disclosure regime that applied to quite frankly, literally as many EU companies as possible, and potentially a whole lot of other non-EU companies that were doing business in the EU, had listings or otherwise. The UK also has its own kind of post-Brexit agenda on green financing, but it's not sustainable financing yet, it's green financing. So it focuses a lot more on the E rather than the S or the G from the UK perspective, but it also is going to require kind of detailed TCFD aligned kind of green disclosures for companies in their reports. And both of these initiatives, whether it's the EU or the UK, will affect cross-border transactions. So we'll just spend a few minutes going through some of the key elements of that regulation before we then move on to what the risks are that are generated by those regulations. Thanks, Peter. So this slide is incredibly detailed. In fact, it kind of only lists a very small number of the legislation which is either in force or is proposed in the EU. And we'll start with the EU taxonomy, because this kind of underpins all of the EU legislation, and it's a classification system. It identifies environmentally sustainable activities. It's a hugely ambitious regulatory piece of legislation. I mean, it's said now, it's only partially implemented, but it's said to cover kind of 93% of scope 1 greenhouse gas emissions within the EU. And it focuses on all forms of economic activity in the EU. It covers cement, it covers metals, it covers batteries. It covers a whole lot of the sectors which have traditionally been fairly dirty sectors from an ESG perspective. It aims for carbon neutrality in the EU by 2050. So it's quite an ambitious project. And what the EU taxonomy does is it basically says that an economic activity can only be covered or can only be considered to be sustainable if it substantially contributes to one of 6 core environmental objectives at this moment. They include things such as climate change mitigation, climate change adaptation, prevention of pollution, transition to circular economy. So those sorts of environmental objectives, and there are 6 in the taxonomy. But not only does the activity need to substantially contribute to at least one of those activities, but it needs to do no significant harm to any of the other activities. So there's a lot of analysis there. It's all set out within both the taxonomy itself and in technical screening criteria. So science-based, really very robust criteria which needs to be met to tick the boxes to say that you are sustainable. And last but not least, even if you do manage to tick all those boxes and you think that the activity is taxonomy aligned, at an entity level, various social safeguards and minimum safeguards need to be met, which deal with other things. So you might not be looking at the E anymore, but the S and the G. So for example, human rights, labor law, taxation, anti-corruption rules. So there's a lot going on there. The taxonomy also has substantive provisions. It applies to companies that are subject to some of the other legislation on this slide, such as companies that are subject to CSRD, or financial market participants who are subject to the SFDR, who need to actually report in their annual reports taxonomy alignment. So for a company, they would have to report the proportion of their revenues, capex and opex that are taxonomy aligned going forward, subject to a phase-in, because actually the CSRD is being phased in. The first reporting year is 24 for reports in 25. So that's the taxonomy, and it underpins all the other legislation on the slide. The CSRD is also incredibly ambitious. This is the EU sustainability reporting requirements for companies. But again, it covers a vast range of disclosures that are required in sustainable reports. that are generated by companies, including obviously environmental and climate change disclosures, but also social and governance matters, employee and human rights matters, anti-corruption, and I could go on and on and on. The list is incredibly broad. One thing we're spending a lot of time on with clients at this moment is the scope of CSRD, so who it applies to. Because there's been since 2014 a non-financial reporting regime in the EU for certain companies. It covered EU, what we called EU public interest companies that had listed securities on regulated markets, and also banks and insurance companies with more than 500 employees. So we've had that regime. It was a regime which required either reporting, or you could comply or explain the reasons you weren't reporting. The reports didn't need to be externally verified. They didn't need to be in the management report of the company, so in the annual report, etc. But there was a regime in place. And so those companies are moving over to the new CSRD. What's somewhat more controversial outside of the EU is it's estimated that approximately 7,000 UK companies, even post-Brexit, will be subject to CSRD, and a whole range of US companies could potentially be subject. And that's because for non-EU companies that have more than 150 million euros of turnover over the last or the preceding 2 financial years, and a qualifying subsidiary that has revenues or net turnover of more than euro 40 million, those companies will be also within the scope of the CSRD. And kind of even closer to home for Peter and I, because as capital markets lawyers, we're advising on listings often of securities. Potentially, if a non-EU company has a listing of securities with a denomination of less than euro 100,000, so retail, what we call retail securities on a regulated market, those companies could potentially also be subject to the CSRD, which means a lot of our clients who have kind of been issuing in Europe on regulated market securities for potentially decades could become subject to CSRD. Thankfully, many of our clients have only ever issued what we call wholesale securities, so securities with a denomination of more than euro 100,000 on a regulated market. Just a few other probably important pieces of regulation to mention. SFDR is the sustainability reporting requirement for the buy side. So we're talking about financial market participants here, such as asset managers, pension funds, UCITS, etc. Its scope is also very wide because it would apply to a non-EU incorporated financial market participant that's selling a product to EU customers within the EU. And it so at least at a product level, all financial market participants need to at least consider whether they're within the scope of the SFDR. It also applies on a fund level basis to funds in the EU with varying degrees of strictness depending on their categorization. So they may categorize themselves as not being a fund that considers sustainability at all. They may consider that their fund has environmental or social characteristics to it, or they may view their fund as just having environmental objectives. So depending on the categorization, the funds will have a varying degree of disclosures that apply to them. I think that's probably all we need to say on the SFDR. Just broadly, because it comes up in some of the risks later, we have a new discretionary EU green bond standard that has been provisionally agreed now by the EU Commission, Council, and Parliament. And that would allow typical kind of use of proceeds, green bonds to be issued, except the use of proceeds would have to be taxonomy aligned. So again, the underpinning of all of this is the EU taxonomy, and therefore it would be stricter. And that taxonomy alignment would have to be externally verified by a licensed auditor. I think that's probably enough, Peter, from here, because we're going to bore people to tears with the regulation, and we'll move on to the next.
I'm glad
slide.
you said it. So the next is, that's you again, I think.
Well, and I only say something very briefly about this. I mean, this is a lovely depiction of actually how this all plays out in reality, because if you can see at the top of this slide on page 6, we have the companies who are reporting under CSRD, taxonomy alignment, and there's sustainability risks, adverse impacts of their business, etc. And that data feeds down a data chain to the end investor, the asset owners, through financial market participants such as funds, etc. So it's a whole ecosystem that's baked in to the legislation, from the EU taxonomy, which applies to all these market participants, all the way through the data chain to the end investors, which is exactly what the work plan of the EU in 2018 envisaged. So they've done their job, whether we like it or not. Peter, I think we can move on to the next slide.
Yeah, so I mean, so just on both slides, I think the key point is that, and we do have another slide that sort of brings this together for capital markets, is that there is lots of European and UK as well ESG regulation that is primarily aimed at European companies, but in many instances does have extraterritorial effects. So CSRD will affect certain non-European issuers. And if you're really interested, we've got a whole talk on CSRD that talks about how that can happen. SFDR will affect asset managers that want to offer fund products into Europe. The EU GBS will affect those issuers that choose to use it. So there's lots of ESG regulation, I think, that's worth bearing in mind over the next couple of years. The second point, I think, is not only is there's lots of new regulation to think about and comply with, that the regulators themselves are really, really very focused on compliance and the regulatory risk associated with greenwashing. So on the slide here, I won't pretend to tell a room full of US securities lawyers about what the SEC have said about greenwashing, but in Europe, I can say that greenwashing and promoting transparency in terms of sustainability disclosures is their number one priority for 2022 to 2024. And the same at the FCA. They're very, very focused on greenwashing and the quality of sustainability environmental disclosures, not just in debt capital markets transactions. So we were talking earlier with a client about how the FCA have come out in relation to talking about ESG benchmarks, saying that they thought that the current standard of disclosures was extremely poor, or very poor was the terminology they used. So it's something that they're really very focused on. Yeah, of course.
Do you have an update on where the SEC is? I guess you have a scandal. The second part to that is, like, for the subset of issuers that are non-EU and would fall under CSRD, like CSRD, whatever. How are you advising those that apply SEC and CSRD and then the other way, like any European issuers that are subject to whatever happens from SEC? Like, how are they paying for all that? How are they doing the gap analysis and how far off they are for multiple reporting regimes that are all coming online, and with all different timelines too? SFDR implemented before CSRD, so how can you report on things that haven't had to come into effect for issuers? My question, sorry. SEC update.
Okay.
Yeah.
So on the SEC, you've probably seen that Gensler is previewing that Scope 3 is likely out of scope, which is a good thing. And that SEC Chair Gensler, once again, last week, when he was testifying in Congress, was to use a non-ESG friendly term, got raked over the coals for his climate change and ESG agenda. So there continue to be differences among the commissioners, and particularly on the accounting side in terms of what goes into the financial statements and is auditable or not auditable. And so we would not expect to see anything from the SEC until sometime in late May. And the rest I leave to you.
Okay, so on the second question, so there are obviously lots of overlapping jurisdictional regimes. So SEC, there is a UK regime, there's a European regime. I think focusing on the European regime, it's actually only quite a limited number of issuers that we look at that are potentially in scope. So you basically have to have equity or listed debt on a regulated market in Europe. Yeah. Okay. So that's the difficult situation. For most issuers outside of the EU, they're not actually in scope until 2028. And in that time between now and 2028, there's also the possibility that the EU, as they've done with other ongoing disclosure requirements, would recognise the equivalence of regimes outside of the EU. So it's quite possible for those kind of issuers that they will say, actually, you know, just wait and see, because we're not kicking in until 2028, but they're just monitoring. And most of the companies that we talk to are sort of monitoring what's going on. It's sort of only the very biggest companies that are doing the gap analysis in terms of whether they're covered by that and the other international standards as well.
I think the other point to make is that the standards that are being created for reporting in the EU are intended to be, to the extent possible, interoperable with standards such as SASB standards or the Global Reporting Initiative, which is used widely in the EU, and they have cooperation agreements with each other to ensure. So the GRI, it's used by Italian companies and French companies for many, many years. They have a cooperation agreement with the IFRS, and they're advising at this moment the companies in Italy to report pursuant to IFRS financial materiality that use GRI for impact materiality. So there is a need for gap analysis, but we're hoping that actually the standards and that are coming out in Europe are not so far different to most of the standards that are being applying in the US and the UK and in other jurisdictions.
So just one point to point out here, that in the UK, for UK regulated firms, it seems extremely likely that this year they'll bring into an anti-greenwashing principle. So any disclosure made by a UK regulated firm needs to be consistent with the sustainability profile of the product or service and clear, fair and not misleading. That doesn't say anything much more than the existing rules already say, but it crystallises it in one rule, particularly in relation to ESG. And then James, you just want to talk finally about key takeaways on the regulatory front.
We've done the gap analysis, which is probably one of the critical points. I mean, CSRD is obviously a live issue. Since CSRD reporting for those unfortunate companies that do need to report in full pursuant to CSRD will be in management reports. And management reports are parts of annual reports that are often incorporated by reference into prospectuses. There is need to consider now how that information is going to translate into offering documents and what liability issues might arise, because there's a whole lot of sustainability disclosure in prospectuses incorporated by reference, and for which issuers take responsibility and underwriters obviously need to be very aware of. Listing retail debt, we've mentioned that. It's probably becoming less of an attractive idea than it ever has been in the EU, listing retail debt on regulated markets. Secondly, the EU Green Bond Standard is now provisionally agreed, and there's no current plan for a UK Green Bond Standard. We don't think there's going to be an immediate move towards many issuers using the EU Green Bond Standard, partly because in various reports that have been published by trade associations and other kind of market participants, data providers, they've only estimated that 3% of assets in the EU that could be eligible assets for a green bond subject to the EU Green Bond Standard are EU taxonomy aligned. And since the use of proceeds have to be taxonomy aligned, it seems to be somewhat early to suggest it's going to become kind of the market trend for green bonds. there's a lot of ESG regulation that will affect bond documentation. And we're going to talk about a lot of that during this presentation, reps and warranties and various other items in subscription agreements and prospectuses and the like. There is UK ESG corporate reporting requirements. There's an estimate that more than 70% of UK companies will, by 2025, be at least reporting environmental disclosures within their reports. So again, there is a UK regime. And last but not least, and probably the core, core message of this presentation is about greenwashing, because as we have these additional disclosure requirements, companies, market participants have to disclose more. There's more regulatory scrutiny, and therefore there's more concern of potential exposures, reputational, regulatory, and litigation.
I think that for those who are not in the EU and are thinking about, how does it affect me? I think that the idea that lots of EU and UK companies will be increasingly reporting sustainability data. And the question for you about whether you want to include that sustainability data in information that's incorporated by reference in your bond prospectus is a really important one, because not all of it will be assured. Some of it will be subject to significant uncertainty. So there's a question mark about to what extent you actually want that information in, or if it's in there, what level of assurance do you have on it, and what level of disclaimer do you have it, what level of sort of risk factors do you have associated with it? And those are the questions that we're getting quite a lot on a day-to-day basis. We're running quite slowly, so I'm going to try and speed up a little bit. But reputational risk, this is quite a difficult one to talk through, but I think what's probably most instructive is just to look at some of those transactions that have, especially in the debt capital market sphere, that have got into the spotlight. So here, James, you want to start with a few, actually?
Why don't we just cover two of them?
Okay.
Because,
so,
do you want to start with one? And then
yeah, sure. So, I mean, DWS is obviously one that's not in the DCM sphere, but is really an example of a litigation action where the claims made in marketing material were unsubstantiated, in that they were allegedly unsubstantiated, and that the green screening criteria, or the ESG screening criteria through which the products were being sold just wasn't going on. So that's quite a common refrain in these sorts of risk cases, where actually the claim somewhat overstepped what was happening in practice.
Maybe I just spend a few seconds on Adani and its sustainability-linked bonds.
Sure.
Because this was a fraud complaint to the SEC, and it was an interesting fraud complaint, because the fraud complaint didn't centre around the disclosures in the prospectus in relation to the issuer per se, or indeed the complaints weren't centered around the sustainability-linked bonds not complying with various, principles, such as the ICMA's sustainability-linked bond principles. What the complaint really centered on was the contentious aspects of Adani's business outside of the issuer, so within the group as a whole. So as we move further into these slides and look at the risks and how to mitigate them, clearly we'll cover due diligence a little bit. But this was a classic example of the disclosures within the prospectus not being fulsome enough, or at least the allegation being that they weren't fulsome enough to cover all of the potential issues within the group, some of which related to the coal industry in Australia and some of the mines in Australia that have been subject to environmental protests for decades, and just simply weren't disclosed in a few lines within the risk factor section of the prospectus or otherwise.
And we sometimes get the question, reputational risk, obviously that's bad for the franchise, but is that what else is it? How else can that affect us? I think I saw this piece of research from a couple of years ago and put out by Morgan Stanley Investment Management, which talks about the secondary market bond price post particular ESG incidents, so post environmental disasters, post social responsibility mishaps and governance missteps. And just the simple point to bring out is that actually, you know, where things go wrong for a company from an ESG perspective, it can have an effect on the price in the secondary market. And if something has an effect on the price in the secondary market, you can see the sort of beginning of a point in relation to loss and litigation. Which brings me neatly onto litigation risk, actually, which is slightly inadvertent. So I'd say I'd start with two things here. First, people talk a lot about climate change litigation, ESG litigation, but actually and I'll talk outside of the US, but in terms of capital markets and securities litigation, I don't think there's been a huge amount. Certainly hasn't been a huge amount in the EU and the UK. Some of the points that I think are important to bring out in terms of looking at ESG litigation on a wider basis is that lots of the stakeholders are from slightly broader range of jurisdictions and parts of society than in traditional litigation. So there's lots of litigation brought by companies, by NGOs, for example. And often they've got different motivations and different barometers for what they perceive as success. So actually remuneration and, achieving material recompense is not often what they're after. What they're after is some kind of behavioural change, behavioural societal change. There's, lots of studies in relation to innovative approaches in relation to ESG litigation. So people who are pursuing governments for failing to apply to or comply with their stated public obligations. Increasingly, I think what we're most interested in, though, is litigation that relates to actions or proceedings where there's been a misstatement in public filings. So, as I said, in the DCM English law bond prospectus world, I don't think we've yet seen that. But on the next slide, we take a look at a couple of the sort of illustrative examples in other areas, just so you can get a sense of what people are actually looking at when they're looking at litigation. James, do you want to talk about the H&M case?
Well, H&M seem to always be in the news for some reason or other, and there's been various cases filed against them. In the UK, the Competition and Markets Authority is investigating H&M amongst lots of other clothes manufacturers and sellers. Here was on the slide is one of the first claims about them. It went to court. It was about the labeling, marketing and advertising of their products as environmentally sustainable, when it was said that kind of less than 20% of the fabric used in their garments was indeed sustainable. Since in 22, there's been claims filed in the US, actually, in a federal court in Missouri against H&M, against their brand, which is called Conscious Choice, with a huge pricing markup on the clothes. I only know because I asked my daughter this, who shops at H&M, and most of the clothes are from polyester. So there's a claim now in the federal courts in Missouri against H&M.
I think actually, it's the same point I made in relation to DWS. It's that gap between claim and actual practice, which I think is what people should be looking at. And I do think you can sort of extrapolate that towards the day-to-day work that we do in terms of reviewing people's corporate disclosures, that difference between claim and substantiation. The other key difference, and where plenty of litigation has happened, is really picking apart the kind of calculations in relation to greenhouse gas emissions and CO2 reduction targets. So the case here, Santos, is in Australia, but the proceeding was really focusing on the fact that they just simply didn't believe the basis of their public disclosures. They said, we looked at your greenhouse gas emission targets and we looked at how you calculated scope 1 and 2 emissions, and we don't think it's correct. So actually, I think, as we talk about the fact that more and more sustainability information is going to be coming on stream, is going to appear in people's filing, it's going to appear in people's prospectuses. Exactly those sorts of points, I think, that make me want to make sure that that information is, one, correct, and two, got subject to really sort of substantive and chunky disclaimers and risk factors.
So we spent a bit of time talking about greenwashing, but the question always comes to my mind: how does one protect the client from kind of greenwashing claims when there is no harmonized legal definition of what it actually is in the first place? There are lots of definitions out there, however, and we put some on the slide. The FCA has defined greenwashing as marketing that portrays an organization's products, activities, or policies as producing positive environmental outcomes when this is not the case. At its core, there is some element of misrepresentation, misstatement, false and misleading practice in relation to environmental credentials. And it could possibly carry, as we've mentioned, significant reputational risk. I think it's also worth saying that both in the UK, we have a green claims code. In the EU, there's now a proposal for a green claims directive. So there's a whole lot of new legislation which is going to come out, which is going to test the robustness of these statements, make sure that they're scientifically based, etc. And actually, paradoxically, it may be that regulation which protects certain clients from greenwashing, because they're going to have to follow kind of a pattern of behavior before they put out the statements, embedded within the legislation itself.
I think we put this slide together for a different talk, actually, but I think it's useful because, again, we often get the question, and before the regulators have really had a chance to say, actually, this is exactly what we think greenwashing is. We just did a bit of a summary and survey of some of the common themes in greenwashing allegations, and I think this is a useful proxy of what to think about when you're looking at particular types of disclosures. So the first is really, really obvious. The statement about environmental or ESG credentials is not correct. That's not novel, a novel piece of information. There've been a number of cases where the statement might be true, but it doesn't tell the whole story of a product or a service. So, X bank is doing excellent work in one particular sector from an ESG perspective, but actually in the other part of its business, it's doing the exact opposite. And a number of the greenwashing claims that have made the press have been about that. The third, I think, is really about the quality of your disclosure. So caveats or conditions to ESG statements. Here you could be talking again about greenhouse gas emissions disclosures, which just aren't adequately disclosed. You haven't shown the working about what you're disclosing there. You haven't shown the calculations. Or ESG credentials could be based on flawed or incomplete evidence, which is essentially what happened in that Santos case that I mentioned before. A lot of information, and in fact there's another claim against H&M, which is where people have said, right, this product is sustainable, and they've given it a particular type of label or tag or rating, and actually that label, tag or rating doesn't really stand scrutiny for many people. And then finally, transactions, and this is one to really think about in the sustainability linked bond context, that where people are rearranging the deck chairs on the Titanic, right, where they do have some merit or sustainability merit to their transaction, but actually that's not nearly the sort of transaction that should have happened to address the sustainability challenges of that particular company. So that's quite a common refrain in public allegations of greenwashing. So I think for sustainability linked bonds, we've got sort of top tips for sustainability linked bonds here, but in the interests of brevity and making sure that we don't run over the hour, I'm actually going to do something different and just refer you to our excellent resource on sustainability linked bonds, which you can take a look at. So we've written a piece recently on all the sort of practical points to think about when you're documenting and working on sustainability linked bonds, and that's really focusing on things like making sure terms and conditions are clear, making sure the disclosures are accurately and adequately produced. So do take a look at that. And if you've got any particular questions on SLBs, either now or after the session, come and find one of us, and we're happy to talk you through that. Yeah.
Going back to what is greenwashing?
Yeah.
Are you giving consideration to what? I mean, if you read the risk factors in any bond indenture, they kind of cover a lot of things that. I'm thinking that you could start including some of that in the risk factors that might mitigate the beachhead that people have on these greenwashing claims.
Yes.
Is that something that you guys are working on, or is evolving in the market?
Yeah, I mean, so if you're thinking about a standard use of proceeds green bond, there is a kind of sort of coalesced market standard around what a risk factor should look like for those. And one of the lines in there says, we don't guarantee to you that this is green because your conception of what's green might be different from ours. I think the thing, and that's been around for a while. I think one thing actually, Dave asked me a question about as this the other day, is that there's much more focus now on the risks and the disclaimers around the disclosure that's going into people's corporate reporting. So we looked at a bank corporate reporting greenhouse gas emissions section, and actually the disclaimer is 2 or 3 pages long. It goes really into detail about what we did, what we didn't do, what we can guarantee, and what we can't guarantee. So I think that's something that people are really focusing on now.
I mean, those risk factors are just evolving. In any case, there is kind of everyone starts with the first set, and then it becomes commoditized, but it does evolve. So where we're saying now in risk factors that the intention is to use of proceeds in a certain manner, but it may not meet the classification requirements of the investor or their internal policies, we're now making reference for the first time, and it's unlikely that the use of proceeds will be taxonomy aligned. This is not an EU green bond standard bond. So they are evolving as obviously the regulation also evolves. Yeah. And there are more things for investors to think about. But yes, I mean, we spend a lot of time on the risk factor section for these bonds.
Do you want to go on to the bit I promised at the start, which is actually what to do about it?
Yes, we did say we were going to speak about navigating risks, not just the risks. So, I mean, ESG risks, just like any other risks in kind of offering a bond in the capital markets, it is subject to the same sorts of risks, and so. The existing practices one used to mitigate risks relating to kind of poor disclosures or other events outside of the issue but within the group, etc., that might arise as controversial activities are very much the same. Underwriters and their counsel need to understand the sustainability profile of the group, the clients, the industry, the transaction as a whole. And how we do that is by structuring the disclosure, making sure that somewhat enhanced due diligence now on ESG occurs. We need to understand the emerging market practice, in different geographies for ESG. And we have to understand that the profile of the client and the transaction and its group.
Just as an aside, the thing I would say is that James and I are securities lawyers and are focused mostly on the day-to-day in and out of capital markets transactions. But when I've done these presentations with people in other spheres, so in the loan space, on the derivatives space, some of the detail is different, but actually it still comes down to the same fundamental points. It's still about diligence. It's still about how you understand market practice. Are you in line with people what people are doing at an industry level and disclosure? So I think this is a slightly focused talk, but actually some of the principles apply more broadly.
So we spend a lot of time on the disclosures, the marketing materials, public statements to check that they're accurate, that they are clear. That includes going back to the sustainability framework as well to make sure we understand it, because often that's the basis for the drafting of the disclosure in the prospectus. We look at statements and making sure that there's no reason to believe that they're overstated and that they're properly explained. So if there is a target mentioned in one of the disclosures, we want to make sure that methodologies that are properly disclosed and that we understand how that target has been reached. ESG legislation is obviously becoming far more complex and it's continuing to develop. So where we see representation, disclosures or representations that there is compliance with a particular principle, we double check that and also make sure adherence is caveated. So I can't think of a non-EU issuer recently where we haven't included in the risk factor section the fact that the green bond does not comply with EU taxonomy and is not an EU green bond standard labelled green bond. That's being included pretty much across the board at present. Common metrics, important, as well as third-party verification, science-based targets. So something that we can see is scientifically based, and you can point to the methodologies is very important. Something we've always done, which is alignment between offering documents, marketing materials, but now corporate sustainability reports, frameworks is becoming more important. Identification, first of all, of what marketing materials are going to be used, and making sure that within the due diligence, questions are being asked about it, and that it's true and accurate, and that it contains all material information, at least alongside the prospectus. And then alignment with institutional policies, commitments of the particular issuer. Because again, as we've mentioned during this talk, there have been a number of cases where, yes, there is a sustainability linked bond or a use of proceeds green bond or social bond that complies with, it might comply with the ICMA green bond or social bond principles. But within the group as a whole, the policy commitments are very, very different to a sustainable future. So we're thinking about these things. We don't have to cover them off on every transaction, of course, but we're thinking about these things.
Getting counsel. Like it's starting to move in that direction. That's a long way. Feels like we're moving a bit.
Yeah, I mean, we can say more on it, but the answer is yes. Because it's, certainly in my experience, Peter, share your experience as well. When we receive the framework and haven't been able to feed into it and are drafting the prospectus disclosures, we often end up almost trying to reverse manufacture the framework because it's not clear enough for us. And we need to make sure the prospectus, of course, as clear as it possibly can be. So, yeah.
Even for instance, like when soliciting. Was able to, quote unquote, duplicate having them along for the ride.
And there's never a silly question either. It's when lawyers are looking at these frameworks, there's obviously a number of items in them where they relate to science, they might follow the UN principles. We may not have all the answers, but where we see something that we simply do not understand, we're happy to ask the kind of silly questions, because there really isn't a silly question in our practice.
I mean,
What's your?
no, I totally agree. I think also because it gives the opportunity for external counsel to put some disclaimers on things as well, which is always valid. And actually, most sustainable bond frameworks didn't have those, and sometimes they increasingly do. But I think they're really important. And then especially in the sustainability linked world as well, there's sometimes you see drafts of documents and the framework as it describes the terms and conditions, which are the terms and conditions of the bond, are just different. They'll just talk about slightly different things. They might talk about different metrics. And I think it's really important that those things are aligned, because, when that goes wrong, or when, as we're increasingly seeing, people are actually failing to hit their SPTs, there's going to be question marks about, which is the correct version should I be looking at? You said this in your framework, but you said this in your terms and conditions. So I think I would say this, but I think the more external counsel look at them, the better.
Yeah, I agree with that. It feels like it's moving.
Yeah. I mean, there are always circumstances. Sometimes you'll, for example, you might be brought on as a co-manager on a deal and the framework's there and you've got data to look at and you just can't do anything. But in an ideal world, yes, I think so. Is that me?
We can move to the next slide.
That's you.
So, I mean, we do kick the tires on the framework. We ask questions. It's divided clearly into the section on the use of proceeds, the eligible assets, the exclusions, the look back, impact reporting, allocation reporting, and the like, and just make sure it does just simply make sense to start with. And then more and more we're seeing due diligence questions on it to, that the framework is accurate, it's consistent with the prospectus and the marketing material. So it makes it even more important that we ask those questions at the due diligence stage, so we can appropriately draft the disclosures for the prospectus. We're looking within due diligence also to kind of flush out ESG risks that may be within the group as a whole, not just sitting at the issuer level. We're also wanting to look at the governance of this and ensure that at all appropriate levels there is internal controls and procedures to ensure that ESG risks are mitigated. And I'm just asking us more and more questions in the due diligence stage to ensure that nothing is missed out.
Not just you.
Yeah, we are seeing in due diligence questionnaires for plain vanilla bonds. Yes, but I mean, again, it's the way one would like to frame this is that, the due diligence and the risk factors that might flow from it are insurance policies for an issuer. And so the more we can convince them that detailed due diligence is beneficial, that's where we'd like to go with this.
Yeah, I mean, the CSD3 is going that way. Clearly, the EU Green Bond standard also requires at the enterprise level that you're doing things.
Diligence on the company.
So,
well, that sort of brings it. So on the point about asking issuers ESG questions on non-ESG deals, I'd sort of go back to that slide and say, actually, well, if you don't ask them about, the potential about their governance, and there's a big governance misstep, then you've got potential causes for action. So I kind of think it's what diligence is for. So I think, yes, I'm sure there are people that resist, but it's it's protective for both.
The due diligence requirements now in EU law potentially bring the due diligence and sustainability to the board and at board level. And there are potential board liabilities for getting this wrong. So, in many countries in the EU for years now, there have been laws of vigilance where companies need to really consider sustainability through the whole supply chain of the company and make sure that they are meeting very basic safeguards. And so you would hope that kind of issuers become more comfortable with questions being asked and really understand why they're being asked at due diligence stage.
The other point I was going to make about CSRD and CS3D is who's going to be doing that diligence, because it's not entirely clear to me. I mean, on a transaction, yes, it will be the lawyers, but if you're talking about other work, it might be that environmental consultants end up doing some of that diligence. Then you've got to think, if you're using that disclosure and the diligence has been done, to what standard has that been done as well? So it's a very good question, and I don't know that we've actually practically seen the answer there.
So on the Adani transaction, when the claim was made to the SEC, the second party opinion provider, the claim having been made, reissued their second party opinion with a 3-line statement at the beginning to say, we stand by our opinion, but there are controversies within the group that we hadn't disclosed, just to let you know. And they reissued it. I mean, so you have to question the value of that. And even if there was some value in that external opinion, all of the other components of the due diligence are also very important.
I think, given time, we should stop there. We have a checklist in the last 2 pages of things just to think about on ESG transactions. And if you have any other questions for us, we're happy to stick around and ask questions now. But
I'm just going to ask the question from the Zoom chat. So really quickly, we've been hearing that even sovereign issuers are facing problems to have their bond issuances taxonomy aligned. This is important for green bonds to be sold in Europe, particularly under the EU GBS, and to eventually ensure the attractiveness of the bonds to be issued, since investors may only want to purchase taxonomy aligned bonds. Do you want to comment on that?
Yeah, so I think James mentioned earlier that there's been surveys about to what extent businesses and sovereigns and supranationals business are actually taxonomy aligned. And when you go through the full gamut of rules and all the different minimum social safeguards, you come to an incredibly low number. So lots of the commentary around the EU Green Bond Standard, which embeds the taxonomy, says that it faces a real and inherent usability challenge. So yes, I think there will be some issuers that use it, but actually it will be incredibly challenging for many issuers, particularly non-EU issuers, to use it.
So we think it will be SSAs, it will be utilities that start using the EU Green Bond Standard first of all, because they will have been considering the standard, considering their taxonomy alignment, issuing long-dated instruments, and hopefully looking to push the market forward with the EU Green Bond Standards. We don't think it will start at the corporate level.
And then you mentioned a case involving fraud allegations with respect to sustainability-linked bonds. Can you discuss?
Which one? That was Adani, wasn't it, I think? Yeah, I mean, so the Adani...
that was Adani.
That was Adani, but I think that slide makes it look more dramatic than it was. So there was a complaint to the SEC, but as far as I know, it hasn't actually gone anywhere. The investor that made the complaint is exactly the type of investor that I was talking about, which is one that's not necessarily in for compensation. They want to bring about change in practice. Yeah.
They are out to do this type of thing, but they're not a large shareholder.
And when I checked with someone about, where has it gone with the SEC, and they said, well, actually nowhere so far.
But also the interesting thing is they've made a follow-on claim as well. I think just last night or the day before, it was in the Financial Times on the front cover. So Adani cannot get rid of this hedge fund investor.
Is that everything?
Yep, that's
Okay.
it from the chat.
Well, thank you very much. If you've got any questions, follow-up questions, feel free to come and talk to us now, or send any of us an email. We'd be more than happy to answer. If you want to know even more about EU ESG regulation, there's more we can talk about. But thanks very much for coming. It was lovely to see you all.
Thank you.
Thank you.